Hey everyone, it's Rob, and I'm going to jump right into it this morning by looking at the emerging markets and the international stock indexes and the bloodbath that seems to be going on across the world so far that the United States has been insulated from. I'm here at the Wall Street Journal's Market Data Center looking at international stock indexes, and I want you guys to pay attention to two columns in particular. Here's a year-to-date percentage change. That would be since January 1 of 2018, and then the 52-week percentage change, because there's an interesting trend that's occurring in 2018 that goes almost night and day or 180 degrees from this column, the percentage change of the last calendar year since September last year. You can see the global Dow is down 1.5%. In the euro, it's up 1.8%. But if you take the U.S. out of it, overall, it's down 7.3%. And that really is the tail of the tape, is this number right here. Outside the U.S., the global markets are down pretty much across the board with a few little exceptions. You can look at China right here, and I'm going to show you another set of market indices for China. But this is the Dow Jones China 88. And that's down 17.4%. So that's looking at the 88, biggest companies in China, and that's down. On the top end, you've got the Shanghai Composite that's down 18.2%, and the Hang Seng Hong Kong down 8.9%. Now, if you go over here and look at the 52-week percentage change in this column right here, those are also down. And actually, the one that's really interesting, the Shanghai's been down longer over 52 weeks than just year to date, and that's sort of an exception compared with the rest of the indices. But it shows that China's been languishing for quite a while. And that's important because China is one of our biggest trade partners. We buy a lot of their stuff. They're still an exporting economy. We're still a service economy where we spend most of our money on other people's goods and services, and we have that negative trade account balance. And most of that negative trade account balance is with China that exports most of or a lot of their stuff to us. And we, our biggest part of the trade account deficit that we have is with China and not with other countries. And, if China's indexes are not doing well, that could be a canary in the coal mine for the United States, because it symbolizes that despite all of the buying that the United States has over China, their markets are still down. Now, does that mean that the U.S. is buying less from China? Does that mean other countries are buying less? China's putting this Belt and Road Initiative in place where they're building trade routes. Why would their indexes be down? I think it's a sign that the U.S. economy is not quite as strong as a lot of people think it is if you just look at the Dow Jones or the S&P 500 index, and that there are indications that the buying of Chinese goods is slowing down, and that's part of the reason their markets are falling. And I think that's a predictor that the U.S. may be close to entering recession as well. You can look across the numbers. The Jakarta is down 10.6%. India is doing well. Although it's slowing down. They were at 20.1% since September last year, only up 11% in 2018. That means since 2018 started, they're actually down a little bit compared to the 52-week average. You've got the Philippines down 9.4%. New Zealand is up. That's nice. That's the rare green print. You look across Europe, and it's almost all consistently down. There's not a lot of double digits down here, and Norway seems to be doing well with 12.1%, and the Netherlands 0.4%. So some of the Scandinavian countries are doing okay. But look at Europe overall. It's not double digits, but they are starting to universally across the Euro trade zone starting to slump, which is a sign that we need to be concerned with, because one of the things I predicted in my book is we would see Europe slump before the United States. And if these start to hit double digits and we get into official correction territory, then that's something we want to watch very, very closely. So, okay, you have Sweden up 6%, another Scandinavian country. Look at Turkey down 20%. We know they're having currency issues and trade issues, but just Portugal, the Russian index is down 7%, Spain's down 7%. If we look at the Americas, overall it's up 6.8%. But look at Chile. One of the strongest economies in South America, has a lot of different climates within the country because it's a long, sort of skinny country if you look on the map that spans north and south. It's got a growing region around the Santiago area, which is much like California, where they grow a lot of their grapes, which is one of their major exports and their main economic industries. But they have a lot of other things that they do as well. And to see that economy down by 9.7%, along with the problems in Argentina, Brazil, and Venezuela, that does not bode well for South America. And that's a strong indicator that we may be going into a continental depression in South America and Central America as well. And as I showed in a previous video, that seems to be sliding up towards Mexico and getting closer and closer to the U.S. Israel's doing okay, 8.2%, good for them. South Africa, the other part of the BRICS nations, down 4%. So just look at all this red on this chart, and I'm going to confirm that by going to look at another group of indexes, the World Market Indexes at indexq.org. And we're going to pay particular attention to some numbers over here. Look at these Chinese indexes. They're all down. In this column, year to date, negative 18.6, negative 16.4, negative 24.6, negative 19.5, negative 24. China's really taking a beating in their stock markets. And because China is one of the world's biggest producers of goods, I really think that this is one of the canaries in the coal mine. Guys, I think this is really predicting where the global economy is going. Because if they're down, that means people are buying less. It means the U.S. is buying less. It means Europe is buying less. It means your other trading partners are buying less, Australia, so on and so forth. But look at all the red. If you just look at the Asian indexes and go to year to date, this grouping over here, almost all in the red with the exception of India. India's doing well. Pakistan is, holding their head above water. Taiwan and New Zealand, and a little bit in Australia. The rest are just taking a beating. Look at the European indexes. Now, again, not a lot of double-digit losses, but almost all red with the exception of the Scandinavian countries. Okay? Go over here and look at the American market indexes. With the exception of the United States, look at these indexes. They're all down. Okay? Venezuela's down. They're all just down. And then if you start looking at some special sector indexes, that can tell you what areas of the economy. I really love this page because it'll tell you what areas of the economy are doing well. I'm not going to get into that in this video, but I just wanted to look at the countries. And it just looks like we're sliding into that global depression. If you guys remember about a month ago or so, I put up a chart that somebody had put out on Twitter where they had looked at the global yield curve, and that's short-term debt issuance rates versus long-term issuance rates. And you would expect in a normal market, long-term debt would have higher interest rates because there's more risk associated with that debt, and you have to have a higher interest rate to attract investment. So if you're looking at a 10-year bond, for example, we don't know what's going to happen 10 years from now, so there's more uncertainty and more risk, therefore you have to have a higher rate. And then the shorter term issuances would have a lower rate because there's a lot less risk if you're only going out 6 months, 1 year, 2 year, even 3 years. And so the shorter the rate, you would expect that you know more about the economy. It's easier for you to gauge, what the risks may be and what may be happening in the near future versus the long term. And so the shorter term rates are going to be lower. We've seen when the yield curve inverts, that means that the short term rates are going up, and then they actually rise above what the long-term rates are, which means that traders and market participants are worried that there's a lot of short-term risk in the market. And when that yield curve inverts and you see higher short-term rates, and that means people are demanding, more return for their money in the short term, it means they're worried about near-term risk and they're worried about the economy. And we saw the global yield curve start to invert about a month ago, and that's usually a predictor of things to come in the economies. In the United States, when the yield curve has inverted in U.S. debt 8 out of the last 9 times since the 1950s, that's indicated a recession. Globally, I haven't graphed out how many times the global yield curve has indicated a future recession, but I assume it would be fairly similar because it's a bigger market and there's more inputs to it. So globally, when all of the different markets participants are looking at it saying we have more short-term risk globally, that tends to indicate a global contagion, maybe a global recession or global depression is coming, because all of these market participants are looking at all of this data across the world, and that's a lot of data to look at and say, we want more money for more return for our short-term money that we're lending you than long-term. So I do think that the global yield curve beginning to invert that we saw in my previous video and that we talked about is an indicator that the world's sliding to recession. And the fact that China is getting it the most right now, and they're one of the world's largest manufacturers, is an indication that purchasing is slowing down in all of the other countries across the world, particularly the Western nations that do the business with China. There is a really good piece of research done by Yardeni, and Dr. Yardeni is somebody that has I believe graduated from Yale University, had worked for Deutsche Bank and some other companies as like their lead economist or lead analyst, has been interviewed by a lot of the leading financial programs on television quite a bit. And so I'll periodically visit the website at Yardeni.com and look at the blog. He's got a really good site on articles that he's reading, which a lot of times I'll follow up on those articles as well. And he's just a really good economist. And one of the things he does periodically is puts out these world indices maps. And so they're a really great way to see what's going on in the world in terms of their economies. If you look at all country, we're barely head above water, the 0% line. The U.S. is way up here. Look at everybody else when we're priced in U.S. dollars. And I'll get to the pricing in U.S. dollars versus local currencies here in a moment. There's a really good chart that Charles Hugh Smith put out from another research analyst that will explain the difference between the U.S. dollar and some of the other currencies. But, minus the U.S., everybody's negative. And if you look at the emerging markets, they're taking it the worst. They're really down here in the negative 12, 14% range, basically since the beginning of 2018. Now, if you do it in local currencies, and you can see that here, he labels it in local currencies, it's not quite as bad. They're closer to the zero line. And all this means is that the dollar is strengthening compared to other currencies. And I'll show you that in a minute and why that's the case and how that affects the stock number. So you really got to look at it from a couple of perspectives. If you look in local currencies, it's not quite as bad. They're still down negative, but it's not in the double digits. And that's consistent with these other two charts that I showed you. Other than China and a couple others, we're not double digits yet. So we're not in official serious correction territory. We're just sort of down a little bit. And when priced in local currencies, that's the picture we get. However, when priced against the strength of the U.S. dollar, we're down a lot more. And I think that's a strong sign that we may be headed toward recession. Because what happens is the U.S. dollar and the U.S. debt are both safe havens for when the rest of the world gets worried. They come into the dollar and they come into treasuries. Even before they go into gold and silver, they come into the dollar and go into treasuries. And what we're seeing is a strengthening of the U.S. dollar. At the same time, we're seeing a weakening of the emerging market indexes. We're seeing the world yield curve inverting, which means across the world people are worried about the short-term risk more than the long-term risk. But in the U.S., the yield curve has not inverted yet, which tells me there's more demand coming in to the U.S. for their debt than there is all of these other countries. It's probably coming from these other countries. And so I think the flight to safety has already begun. I think people are starting to see the economic numbers across the world, especially in the emerging markets, especially in China. And the flight to safety to U.S. bonds and to the U.S. dollar has already started. And I'm going to call it before most analysts will call it. But I think that's clear in the data. That's what's actually happening here. As we look at some of the share price index in dollar, you can see it's grouped. Emerging market, Europe, UK, they're all down. We're just going to scroll through some of these charts. And again, in local currencies, not down as much. That just shows that the dollar is stronger in these other currencies. Let's see. Yeah, it's got basically emerging markets Asia, emerging markets Latin America, emerging markets in general. And you can see that emerging markets Latin America are doing worse. And again, the video I did recently, is Mexico the black swan, that we missed or something along those lines. I just did the last few days ago. You can see why I have concern about Mexico and the other Latin American countries, because their markets, when you plot them out, are worse than the other emerging markets, which is astounding. It means Latin America is really being affected first, and where we all thought it would start in Europe first or Japan, it may have actually started in the Latin countries first. So that's a very interesting development. A few other charts that Yardeni does, he breaks the European nations down. I think it's interesting to see that Germany, this line, this sort of teal line, colored line right here, is doing the worst of these big European countries. And again, this is a sign that we're heading into recession because Germany is a big manufacturer. They're sort of the manufacturing development engine for all of Europe. And the euro and the European Trade Union tends to go as Germany goes. So Germany is sort of to Europe what China is to the rest of the world in terms of production, in terms of innovation, in terms of being, the big exporter. And when their markets are down, that's an indication that other European countries are buying less of German goods. And that's an indication that Europe is sliding into a recession as well. Excuse me. And of course you have some Greece, Ireland, Italy, Spain. Greece has just plummeted off. We all talked about this in 2009, 2010, 2011 when Greece was, we thought they were going to default on their debt and they got bailed out. They really haven't gotten much better since then, so that's not a surprise. Anyway, I'm not going to belabor the point here. Go look at Yardeni's research. Look at the charting. It's wonderful. This gets put out, I don't know if it's quarterly or monthly, but every once in a while I'll just come to the site and wonderful graphs that really give you an overall picture of where the world is. Here I want to transition to currencies because, as I mentioned, there's a flight to safety, I think, going on into the U.S. currency. And I think the strengthening of the U.S. dollar is a sign that other people are, even though I've talked about the non-petrodollar contracts being negotiated in the Chinese yuan and in the Russian ruble, the U.S. dollar is still the world reserve currency in terms of what people see as a safe haven and what people will go to, when the chips are down. And I think we're going to have a temporary spike in the U.S. dollar as people fly to it, and then eventually the U.S. dollar is going to die as countries get out of the U.S. dollar and go into other currencies. Other analysts have basically called this like a melt up in the U.S. dollar, where it's not going to crash and go down to zero right away. It's going to melt up to such a high level, such lofty expectations, and then it's going to go into some hyperinflationary phase where, as the Fed is printing money to pay off the debt, it completely loses it. But I think there's going to be this flight to safety in the dollar, and I think that's why we see all of these currencies going down. Of course, Venezuela, we know what a train wreck that is. The Bolivar is down 100% to the dollar in 2018. That's not a surprise. They were just revalued their currency. You've got Sudan, Argentinian peso, Turkish lira, Angolan kwanza, the Brazilian real, the Liberian dollar. Look at all of these currencies just getting smashed compared to the U.S. dollar. Even the Indian rupee. The interesting thing to note, even though India is up this year in their stock market, they're still down relative to where they were 52 weeks ago. Remember that? And that shows up in the currency. That's why you can't just look at a stock market. You got to look at currencies and other things, and that's why I'm focusing on both for this video to tell the story, because even though India is positive, net positive for the year, they're down since September, and you can see that weakness start to show up in their currency as well. Of course, they had currency issues, trying to go cashless, trying to revalue their currency. So we know what the issues were there. And Pakistani, we saw that the Pakistan market was up something like 1.7% in 2018, but yet their currency is still down 10%. So that's still a sign of weakness in their economy, in particular with when the currencies get weak. That usually shows countries don't want to invest in that currency because their economic fundamentals aren't great. So this could be a sign we've got double digits all over the place that all of these economies are starting to weaken. And that really shows that the U.S. dollar is strengthening. There's a flight to safety to the U.S. dollar, to the U.S. bond. I think the world recession has started. We saw the global yield curve invert. We're seeing these markets go down. China has plummeted, and it's basically a manufacturing engine for the world. Germany and Europe, which is a manufacturing engine for Europe, is really started to plummet. Those are the canaries in the coal mine for their respective areas, and then for the world, and seeing, how all the rest of the markets, that rely on these manufacturing companies are starting to slump behind them as well. And then everybody's flying to the U.S. dollar and the U.S. debt. That's why the U.S. stock market is so strong. That's why the U.S. dollar is so strong. That's why the U.S. yield curve has not inverted yet. But I'm telling you, ladies and gentlemen, it's started. This process has started. We're officially in it. And when I said in my previous video, looking at the yield curve, I thought it would start in fall of 2018. I don't know that the U.S. recession is going to start in the fall of 2018, but as sure as hell has started around the world, and it's going to reach the U.S. eventually. I don't know how long the U.S. can hold out, but I think eventually it's going to hit the U.S. And the foundation's been laid for non-dollar contracts and non-dollar trade. The Belt Road Initiative that China's putting into place and trading outside of the seas and doing it across land, the contracts that they have with the Middle East and with Russia. Europe is starting to turn east a little bit. You're starting to hear Germany and some other nations do some deals with Russia and China as well. All these foundational pieces to shift trade away from the U.S. So what's going to happen as the recession starts to hit the U.S., the fundamentals aren't going to be there to keep the U.S. out of it. And the U.S. is going to start to suffer, and then the other nations are going to band together and support each other while the U.S. is going to be isolated. That's what's going on, and I'm trying to bring this all together for you guys as it happens and do a play-by-play as it happens so you guys can see how this works and see what's going on. It's really important to pay attention to this data, Come back to my channel, view my videos. I'm starting to crank them 3 to 4 times a week now. My original promise was to do 1 a week, and I was trying to build a subscriber base. At this point, I think we're in the quickening phase. I think things are starting to move faster. So I'm going to start hitting you guys with videos, at least 3 to 4 times a week, if not every day, if I can. And come back to the channel. Pay attention to this stuff, guys. It's very important. It started around the world. It's going to work its way to the U.S. This is your canary. This is your warning sign, your warning siren. If you have a tornado siren in your area, when that goes off, you may only have a minute or two before bad weather hits. Okay, this is your relatively short period of time. This is your warning bell before the stuff hits the fan in the U.S. or starts to hit the fan in the U.S. Before it's going to be harder for you to make any financial preparations. You need to start now. We're running out of time. The warning bells are sounding around the world. You're seeing it in the heavy manufacturing companies, Germany and China, which are indications that people are buying less. That means recession's coming across the world. This is the first stage of it. It's coming. Pay attention, guys. Come back to the channel, subscribe, give it a thumbs up, comment, ask questions. I'm here. I will watch the comment stream. When I start getting comments, I'll start answering to those comments and bringing you guys more information. Let's get interactive here. I'm doing this for free. I'm doing this for you guys. I'm doing it to help you guys prepare. I've been talking about this for 7, 8, 9 years, and now we're in the 11th hour. We're in the witching hour now. We don't have much time left, so pay attention to the videos, subscribe. If for some reason you're not getting updates through the social media, come back every day and check the channel. I'm going to keep cranking the videos, watch the videos. Definitely ask questions. If you've got some additional data you want to add to the discussion, do that. But keep coming back, guys. We need to talk about this. We need as many people prepared as possible if we're going to make it through this. I think it's starting for real, and you can see it in the numbers. Hopefully this video was helpful to you guys. Till next time, this is Rob on the Sui Jurist channel.